Vanguard's very surprising investment return projections. All right, this is interesting to me, and I was kind of, what's the word I'm looking for? I don't want to say shocked, but I went like this, huh? My eye like that, huh? I can't do it, something like that. So let's bust out the PVC pipe. The PVC pipe of knowledge. All right, so we're going to talk about the Vanguard future return projections. We got 10 and 30 years behind us. And Vanguard, every year they put this out. I thought I've downloaded them, going back to 2012. I got so much crap on my computer, I can't find anything. So I'm sure there's a way you can find the older projections they've had. I don't want to take the time to look at it. But anyway, be it as may, this is what I use in my own assumptions in the markets as well. All right, on Right Capital, I'm saying. There'll be a couple of small iterations here, but let's go into it. So Vanguard Capital, the Vanguard Capital Models Market, VCMM, Vanguard Capital's Market Models, I think that's what it's called. Vanguard Capital Models Markets Model, something like that. Anyway, so we got 5 different things here. U.S. equities, global, U.S. bonds, cash, and inflation. U.S. bonds is all inclusive, not just government bonds, it's corporate bonds as well. And the interesting thing that jumped out, for 10 years, U.S. equity, Vanguard is predicting a gross, what's called a nominal rate of return of 5.2%. That just simply means before inflation. Yet U.S. bonds, they're predicting a higher rate of return than U.S. stocks. Not much, 10 basis points, but still, nonetheless, 5.2 for U.S. stocks, 5.3 for U.S. bonds, with inflation at 2.5. So essentially, inflation, according to Vanguard, is going to eat away a half-year rates of return on U.S. stocks and U.S. bonds. Now, they're also projecting, and Vanguard's notoriously been bullish on international stocks for I think they're 100% stock portfolios, like 60% U.S. stocks, 40% international stocks. I think it's been like that for years. And they've been substandard in terms of that because international stocks just haven't done much. But anyway, you got 8.1% for global stocks. I didn't even put emerging markets in here. I'm just doing global. So, that's a significant difference between 8.1 and 5.2 for U.S. equities and global. The thing with global, this is what I don't understand. So Vanguard uses the Bogle Model, John Bogle, the founder of Vanguard, and how you get future stock returns. It's quite simple. It's earnings growth, e.g., plus dividend yield, plus minus PE, contraction or expansion. All right, so if we have 5% earnings growth, 2% dividend yields, that's 7%. Then we're going to add or reduce that by whether or not people are willing to pay more for a dollar of earnings or less. That's price to earnings contraction and expansion. Now, we can't really predict that. We just don't know. Well, are you willing to pay more for a dollar of earnings a year to 2 to 3 years from now than you are, or less for a dollar of earnings? No one knows. But the two constants are earnings growth plus dividend yields. And again, even earnings growth, we don't exactly know. And that's where we do some modeling and projections and stuff like that. That's what the financial analysts and the CFAs that Vanguard has, that's what they do. And all these firms do. So in this case, if we're looking at earnings growth plus dividend yield, and we only get 5.2 nominal, well, most of that is going to be, dividend yield right now is about 1.5 on the S&P 500. So we're talking about 3.5, 3.7% earnings growth year over year. Or they're saying that people are going to be will be less willing to pay for a dollar of earnings. All right, so there would be PE contraction, which reduces the prices of your funds. I don't want to dive too deeply in this here because this is a kind of a side note. I don't want to go down too far here, but that's how you come up with it. Earnings growth plus dividend yield plus or minus PE. And PE goes up, i.e. you're willing to pay more for a dollar of earnings, or PE goes down, you're not willing to pay more for a dollar of earnings. You're going to pay less for a dollar of earnings. And that's kind of demand, if you will. What's my demand in the markets? So they're saying only 5.2, and again with inflation at 2.5, that's a 3.7% rate of return. That's a net rate of return, or what's called real. It's not bad. It's still almost 4%. I'll take it. Now, here though, where are they getting the earnings growth from? That's what I don't quite get. So the global market is 8.1%. Same thing is applicable here. Earnings growth plus dividend yields plus minus PE contraction or expansion. I don't see PE contraction, expansion growing that much, frankly. I just don't. I mean, I get it. There's always people who chase yesterday's winners, but I don't think enough to move markets. I just don't. So in this case, it's just all based on earnings growth. Well, where's the earnings growth going to come from? I mean, China's hurt for certain, man. I mean, their real estate market is, I mean, where is the earnings growth going to come? I don't know. And Europe's freaking dead to rights, man, because of the replacement Europe's going through. I mean, they're replacing their own citizens. Like Ireland is like, hey, come on over here and kick out our own Irish people. You know, we'll give you free places to live, even though Irish people they can't afford rent. It's nuts. And so the replacement was literally the great replacement is starting to happen. It's not starting. It's been happening in the United States for a long time as well. These are just facts. So the great replacement, what does that reduce? It reduces earnings growth because the people replacing the natives don't have the cash flow. They just don't, man. A lot of these people are going to be on welfare. So where's the earnings growth going to come from? I don't know. I mean, then we got massive debts in China and real estate collapse. It's nuts. India, maybe. I mean, there could be some significant jump in price to earnings, or at least earnings growth in India, maybe. I don't know, though. I don't know. And where else is it going to be? South Africa? I mean, the ANC, the commies, and South. I don't know. You know, Brazil. I mean, come on, man. They're still run by that clown down there who was in jail. I forgot his name off the top of my head, and that guy's a clown. And Argentina, because this supposed libertarian guy. Oh, man. Earnings growth. Where's the earnings growth going to come for foreign markets? I mean, look, I could 100% be wrong. Israel, probably. Big Pharma loves them some Israel, that's for sure. But I mean, right now, Israel's got problems in the Red Sea. I mean, they're basically the Houthis in Iran is kind of stopping the shipments of fuel and other imports into Israel through the Red Sea. And that's the thing. When you're relying on imports to manage your life, your day-to-day living, if something breaks the imports, i.e. the supply chain, you're going to be in a world of hurt, and you're going to see mass inflation. Oh, nothing to do with M2. Increase in M2 is crazy. When supply chains break down, scarcity happens. And what happens when scarcity? Inflation. Oh, but it has to do with the U.S. printing. The government printer go burr and inflation. Oh, it's so silly. Anyway, so where's the earnings growth going to come from? Look, I could be wrong. I don't know. But Vanguard has been preaching international for a long, long time. You'd think at some point they're going to be right, but I don't know that. So then we got U.S. bonds at 4.6, cash at 5.3, cash at 4.6, and again, inflation at 2.5. That's for 10 years. On standard deviations right here, you can't really see that very well. Stock 17, global 18. So what this means is we take 17 times it by 3. 17 times by 3 is 34, 51. So in any given year, we'd expect U.S. equities to have a 46% decline on any given year. 46%? It's never happened. Never happened. In 1930, U.S. equities were down 44%. But guess what? Inflation was down 10. We had deflation. So that's what I'm using too, by the way, just FYI. That's what I'm using in my spread, in my models and right capital. So low expectations for rates of return, continued high expectations for volatility, standard deviation. The global market is even bigger. 18 point, I can't do that in my head. Is that 54, I guess? 54, but with an 8% rate of return. So they're actually saying the global markets could have a 46% decline, the same as the U.S. markets as the worst case scenario, within a 99.8% probability based on these two metrics, average rate of return and standard deviation. That seems a little bit crazy to me, but that's okay. Vanguard, again, has been bullish on global stocks for many years. But look at this. So you have a third of the risk in standard deviation in bonds with a higher rate of return. I don't know what else to say, man. And people are going to say, well, I'm going to wait till the Fed lowers rate before I jump into bonds. Look, you do whatever the hell you want to do. I just think you're making a mistake. The Fed doesn't say, we're lowering the interest rates, and all of a sudden people jump into bonds. People have been jumping into bonds for the last 6 weeks in anticipation of that. But whatever. I mean, it's just people like the same kind of thing with, analysts think the dividend is going to be cut on AT&T stock. Well, I'm not going to sell my stock until AT&T announces a dividend cut. And a lot of times by then you're too late, man, because the analysts have already been thinking it's going to happen and they've been selling their shares. So now when AT&T does announce a dividend cut, there's already a 20% to 25% decline in the share price. And I'm just using AT&T as an example. It's the first thing that came to my head. All right, so then we got cash. Look at that, 4.6. It seems a little bit high to me. I'm not using 4.6 in right capital, and I'm not using 2.5% inflation. I'm using cash at 3, and I'm using inflation at 3 as well. Now, healthcare inflation, I'm using 5.5. So the overall all-in inflation for my right capital is probably about 3.25, 3.5. depending on how much expenses you have relative to healthcare. But 5.5 for healthcare and general inflation at 3. I'm not increasing my cash to 4.6. No way. I don't expect that to happen at all. I think this is probably a little bit short of what it will be. I don't have any global stocks. If you want global stocks, I think I use a 6.5% rate of return on global stocks. I can't remember. But my U.S. stocks, I'm still using 6%. My bonds, I'm going to still use 4. Yeah, 4%, 10-year treasury. Cash, I'll still use 3. Inflation, I'll still use 3 as well. So I'm more pessimistic even than Vanguard across the board, except for U.S. stocks. Standard deviation, these are all about right, 100%. So that's what I'm using here. Now that's for 10 years. For 30 years, they got a higher standard deviation of both, basically everything. Yeah, everything. This is the standard deviation for 30 years. Vanguard would say you should average a 6.4% rate of return on U.S. stocks, 8.5% on global. U.S. bonds should drop to 5%. The 30-year stuff is so silly. We don't know. But cash would give us 3.7 and inflation of 2.2. Yeah, I don't buy that. I don't use any of this in my modeling. I just use this right here. And again, I just shared you what I use. So again, I don't see how Vanguard thinks this right here is going to sustain it for 10 years. So people, I guess you could say, well, global stocks, you could look at Japan over the last couple of years. But I think I read 40 or 50% of Japan market is owned by the Japan government or the Japan Fed, the Bank of Japan. I can't remember which one. Maybe a combination thereof. So they've just been buying up equities like crazy. And all these people say, well, Social Security should buy stocks too. Now, do you want the federal government owning your shares? I don't. That's fascism 101, man. Do you want the government owning and voting on your shares? I don't. Yes, there'll be initial freaking run-up when the federal government's buying it because, the price of anything is supply versus demand. When you have demand going through the roof and the supply stays the same, and inherently you're going to have increased prices. And so everyone's like, oh my goodness, the federal government should have been doing. I just read all these articles about Social Security. If the federal government had invested in Social Security for the last 40 years, I'm like, Phil Graham, the old senator from Texas. I just like, dude, what are you talking? What? Phil Graham, you lost any kind of ore you had when you Graham Leach Bliley Act that basically got rid of the what the hell was the banking regulations on I can't remember what it's called, from 1935 or something. I just forgot which one it was. 1932. I'm drawing a blank because it was in 2009. No, it wasn't 2009. It was 1999. Jim Leach from Iowa, gay congressman from Iowa, and Bliley from Virginia. And both those guys are congressmen, and Graham was a Republican senator from Texas. I forgot what bill they got rid of, but they got rid of one of the banking regulations where investment companies and banks could merge essentially. I was all for it, and I was wrong, 100%. But anyway, so Phil Graham's like, if we only would have invested in stocks in the last 40 years, we'd have trillions of dollars of surplus in Social Security. I'm like, A, you don't know that because you don't know what the federal government would have done with the stock holdings. And B, on top of that, do you want the federal government being run by the likes of freaking Hunter Biden, dictating the companies they're voting? Oh my God, I can't believe people fall for this. The federal government's going to invest in Social Security. What happens to the voting rights? Well, no one ever thinks like that. They don't. So they have these shares. They're basically Vanguard on steroids, BlackRock on steroids. This is literally what's happening in Japan now. All right, so Japan owns 40 to 50% or something like that of Japan stocks. The Japan government does, or the Bank of Japan. Did anyone elect anybody from the Bank of Japan? No. Who votes on the Japan shares? I don't know. I don't care to look into it. I don't want that happening in the United States. I'll tell you that right now. Can you imagine? Who's that? Lloyd Austin, for instance. We'll just say he becomes a new federal chair, or Hillary Clinton, or Elizabeth Warren. All right, if you can't hire any more white people, any more white men, you can't hire. Why? Because they're too much overrepresented. Okay. And if you do hire, we're going to sell your shares, or we're going to vote against you for the board of directors. Okay, Elizabeth Warren. It's like right out of Atlas Shrugged. Anyway, so I'm pretty comfortable for this for the next 10 years. A little bit, I think that's a little bit shy. That's a little bit. Well, I already said all that. So there you go. That's a Vanguard. Shocking is too strong a word, but Vanguard surprising investment projections for 10 years. Let me hear your thoughts. What's your projections? And if you say the dollar is going to bottom out because of BRICS, just try. Can we try something else? or the inflation will destroy America. I just, come on. Give me something to bite on. I need some good thinking here. I don't want I'm just so over that stuff. All right, love your thoughts. We'll see you.